Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, March 5th, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story continues to be the pressure building across multiple fronts. We're seeing Treasury yields hit a three-week high as inflation fears intensify, which is creating some real tension in fixed income markets. The Wall Street Journal is calling it hell for bonds, especially now with the geopolitical backdrop. What's particularly notable is the divergence we're seeing between investor behavior and market fundamentals. Retail investors are completely unfazed by the volatility and keep hitting buy, which is that same pattern we saw through previous shocks. On the corporate side, Morgan Stanley just laid off 2,500 employees across all divisions, which signals companies are getting more cautious about their cost structures. Meanwhile, we're seeing significant movement in commodities, with oil pushing higher on Middle East tensions, and gold is heading higher once more, though the stronger dollar is limiting those gains. Europe is confronting the threat of another energy crisis, and we're seeing the fastest gas price increase in 20 years. The AI narrative continues to dominate, with Wall Street talking about creative destruction coming for entire companies, and there's this interesting tension between the promise of AI and the reality of job displacement.
That's painting quite a complex picture. How are you reading the market's interpretation of all this?
Markets are clearly in a risk assessment mode right now. The fact that Treasury yields are climbing while stocks remain relatively resilient tells me investors are pricing in persistent inflation rather than recession fears at the moment. The institutional money seems to be rotating into defensive positions, which explains the gold strength despite dollar headwinds. What's really interesting is the private credit story that CNBC is highlighting, where investors poured billions in and now many want their money back. That's a liquidity concern that could have broader implications if it spreads. For traders, the key is selectivity right now. The sectors benefiting from energy price spikes and defense spending are obviously in focus, but you need to be careful about duration risk in your portfolio given where yields are heading. The retail investor optimism is actually a bit concerning from a contrarian perspective, because when everyone's buying the dip without discrimination, that's often when you see the real corrections happen. I'd be watching credit spreads very closely over the next few weeks as a leading indicator of whether this tension resolves bullishly or bearishly.
Steve, let's get into the economic numbers. What's the picture looking like?
Thanks, Robert. Let me walk you through what we've seen this week and what's coming. Earlier this week on Monday, we got the ISM Manufacturing PMI, which came in at 52.4, beating the forecast of 51.8 and showing continued expansion in the manufacturing sector, though slightly down from the previous reading of 52.6. That's important because it keeps us in expansion territory above 50. Then yesterday, we had the ADP employment report, which showed 63,000 jobs added in February, exceeding the forecast of 50,000 and a significant improvement from the previous month's 11,000. That sets up an interesting dynamic heading into the official employment data. Now, today we're getting initial jobless claims, and this is a key read on the labor market's health. The forecast is 215,000 new claims, up slightly from the previous week's 212,000. This indicator matters because it's our most timely gauge of labor market conditions, and any significant deviation from expectations could move markets given the Fed's focus on employment data. If we see claims come in below forecast, that reinforces the narrative of a resilient labor market, which could keep the Fed cautious about rate cuts. Conversely, a spike above 220,000 would raise some concerns about labor market softening. Looking ahead to tomorrow, we have the big one: non-farm payrolls, with a forecast of 59,000 jobs added, which would be down from January's 130,000. That's a significant deceleration and will be closely watched. We're also getting retail sales tomorrow with a forecast of 0.3% growth, which will tell us whether consumers are still spending despite the higher energy prices we've been seeing.
Those employment numbers tomorrow are going to be critical. Lizzie, let's shift to our stock of the day. You're looking at Adobe, which has had quite a rough stretch. What's your analysis?
Adobe is one of the most compelling risk-reward setups I'm seeing right now, Robert. The stock is down 39% over the past year and 18% year-to-date, currently trading at $273.12, which puts it very close to its 52-week low of $244.28. The market has absolutely hammered this stock on fears of AI disruption, worried that generative AI tools like Midjourney and Stable Diffusion are going to cannibalize Adobe's creative software business. But here's what's being overlooked. Adobe just posted 10.5% year-over-year revenue growth in Q4 with record operating cash flow. And management is aggressively buying back shares, which signals they believe the stock is significantly undervalued. The valuation metrics are screaming opportunity here. We're looking at a P/E ratio of 1636, which is below historical averages for a high-quality software company. But the forward P/E is just 10.35. That's exceptionally low for a profitable cash-generative software company with double-digit revenue growth. Either the market is pricing in massive earnings growth that isn't reflected in the price, or there's extreme pessimism baked in.
That forward P/E does seem disconnected from the fundamentals. What about the AI concerns that have been weighing on the stock?
That's exactly the debate, and I think the market is missing the bigger picture. Adobe isn't sitting still. They've been actively integrating AI capabilities through Firefly and Sensei into their products. The key question is whether AI enhances their offerings or disrupts them. And I lean toward enhancement. They just announced the acquisition of SEMrush Holdings, which expands their SEO and online visibility capabilities within their marketing suite. This is strategic because it positions them better in AI-driven content and marketing workflows. The company has an earnings report scheduled for next week, and that's going to be a critical catalyst. If management can articulate a clear AI strategy that positions Adobe as a beneficiary rather than a victim, we could see a significant re-rating. The analyst consensus target price is $406.04, which represents 48.7% upside from current levels. 33 analysts cover this stock with a buy recommendation and a rating of 3.5 out of 5. The stock is trading 39.6% below its 52-week high of 452.51, so there's substantial room to recover previous valuation levels. Looking at year-end targets, I think a realistic range of 350 to 410 is achievable if the earnings report addresses AI concerns and demonstrates continued growth. The risks are real. AI disruption could accelerate. Growth could decelerate further, and we have macro headwinds in enterprise software spending. But at these levels, with this valuation, and with Adobe's dominant market position and high switching costs in their subscription model, I think the risk-reward strongly favors the bulls. For investors with a 12-month horizon, current levels offer an attractive entry point, though I'd size positions carefully given near-term volatility potential.
So you're viewing this as a buying opportunity despite the significant drawdown. Let's move to crypto. What are you seeing in digital assets?
Crypto markets are showing real strength right now. Robert Bitcoin briefly topped $73,000 this week, with Bitcoin ETFs pulling in $462 million in inflows, and we saw another $155 million come in more recently, extending a 2-week inflow streak. That institutional demand is the key story here. Morgan Stanley just named Coinbase and BNY as custodians in their proposed Bitcoin ETF filing update, which shows traditional finance is getting more comfortable with crypto infrastructure. The sentiment for Bitcoin is bullish heading into next week. But there's an important technical level to watch. Analysts are warning that Bitcoin must hold above $70,000 to avoid what they're calling a bull trap. We're approaching a 2-year make-or-break price zone, and there's talk of an air pocket above 72,000. That could mean a quick run to 80,000 if we break through convincingly. The institutional versus retail dynamic is interesting. Institutional investors appear to be buying the dip, with $1.7 billion pouring into spot Bitcoin ETFs recently, while retail attention on altcoins has actually sunk to a 2-year low as Bitcoin holds all the attention. For Ethereum, we're seeing bullish momentum with ETH surging 8% alongside other altcoins as war fears ease. The Ethereum Foundation is exploring the network's role as a trust layer for AI, which is a compelling long-term narrative. Ethereum needs to reclaim $2,400 to confirm a bullish reversal, and if it does, I think we could see continued strength. The sentiment is bullish for next week. Solana is particularly interesting right now. Solana stablecoin volume hit a record $650 billion in February as on-chain payments draw demand, according to Grayscale. The Solana Wallet Backpack just launched an on-chain IPO service, and we're seeing strong ecosystem growth. Sol gained 5.6% recently, leading the CoinDesk 20 index higher, and Western Union teamed with Crossmint to support a stablecoin on Solana. The sentiment is bullish, with continued upside potential as the ecosystem expands. The key factors to watch across all three are the ability of Bitcoin to hold 70,000, any regulatory developments, especially with Trump sending a pro-Bitcoin Fed chair nomination to the Senate, and whether institutional flows continue at this pace. The risks are profit-taking after this rally and any broader market pullback, but the momentum and institutional involvement suggest crypto has legs here.
That institutional adoption continues to be the story that changes the narrative around crypto. Well, that's all we have time for today. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to The Morning Bell wherever you get your podcasts. I'm Robert, thanks for listening, and we'll see you tomorrow.